Hello, in this video, let's discuss a few more cost classifications we used in the decision-making process. In this part, I'm directly using the ebook for this discussion. The cost items we are talking about here are not the items we directly put in the accounting system. So it's not really like a direct material cost or labor or overhead. These are the cost concepts when we analyze a situation, compare different scenarios, especially help us identify relevant information from irrelevant information when you try to finally make the decisions. So relevant cost as compared to irrelevant cost. Let's first take a look for the differential cost and the revenues. So differential cost or differential revenues. These two items are always relevant because they represent the differences between the revenues and the cost when you compare to different scenarios. So revenue differences between three options and the cost differences. So they are always relevant. If we ignore the differences between revenue and cost, you may omit important information for the decisions. And sometimes another name for the differential cost, you also can see incremental cost or incremental revenue. So incremental or differential, they use the words interchangeably, but the focus is the difference. So means differences, the revenue differences and the cost expenses differences. And let's take an example. So we have a cosmetic company, or it's a very common situation. We are comparing two marketing scenarios. So you are trying to advertise or try to sell more, so make more profits for the line or products. We have two marketing scenarios. One is use the retailer distribution. For example, you put it in CVS or Walgreens or Walmart Target for our product lines. And another marketing option is use the network of sales representatives. Or rather than putting in a store, I'm using my neighborhood friend network, or expanding or build a neighborhood network. So here we are comparing two exclusive options, or rather than you are saying, partly I may use the retailer. Also, in the meantime, I'm hiring the sales representatives. You can do that, but for this example, we are comparing them as independent options. So when you compare the two different options, your goal, so our goal is maximize the profit earned by the company, right? So that's your comparison benchmark. But for us to know the profit difference, we must identify the revenue difference and the cost difference between the two options. So you have you have a list of the items in the table by the two options. And here we are listing all of the related items, okay, sales, revenues, and the cost of goods sold, then the different expenses. So when you compare the different items, we can see most of them are different between the two options. Differential items, differential revenue or differential expenses, such as the revenue, the sales rep can make 100,000 more than using the retailers. So revenue are different. Then the cost of goods sold are also different because cost of goods sold varies with the sales revenue. Normally, the more revenue you earn, the more cost of goods sold. Advertisement expense is also different. So you spend more on the retailing distribution. Commissions. Okay, so commissions is another differential items. 0 for retail, and then a lot of commissions paid to the sales rep if we use the second options. Then warehouse rental, we have less expense if we use the retailer distributions, but you have to have your more of the warehousing facilities for sales rep. Then I highlighted one item is other expenses. So you can think about other supporting operational expenses, maybe your admin or other expenses. And this item is identical between the two options. So 0 difference. So even we listed here, there's no impact, so differential impact on the profit. So this is a irrelevant items, or even I put in this table, but later once you become experienced, when I see there is no difference between this item, I can ignore it in my analysis scenarios. So I can focus on the differential items only. So now let's looking for the third column, okay, the last column, which focus on really the differential revenue and the costs. So revenue difference, then cost difference, and then the total difference between the two options. We are using the retailer as a benchmark, okay, sales compared to the retailer. So overall, the sales rep, the network method can help the company make 15,000 more profit than the retail options. How we can know? You can see the revenue difference is 100,000, right? And then all of the cost and expense difference is 85,000. So the incremental revenue or differential revenue of the sales rep is still higher than the incremental cost part by 15,000. So you have an incremental or overall differential profit 15,000 more by using the sales rep than the retail options. So by making this comparison, if you just decide based upon the financial numbers, probably you should choose the sales rep network. You may have some other concerns or considerations like non-financial considerations, but that's other stories. So if we focus on the financial numbers, so the sales rep is absolutely better than the retail options. So you can see this is a differential analysis approach. And once you get experienced, you may ignore the two columns. I can focus on the third column only and focus on the differential items. I can ignore the other expense. It will not impact my final decision. Okay, so if you focus on this one later, that's really a differential approach, and it can narrow down your numbers and it help you give a simplified analysis, okay, for your decision making. But when we start, if I have all of the items, okay, you can normally they call full cost, okay, full cost analysis. The full cost is very detailed, or it help us bring all of the items into consideration, but but you can see here the other expense. So finally, we don't really need it. So we use this example to explain more when you compare two or more options. Only the differential items are relevant in making the final decisions. So you can ignore all of the same items under the different alternatives, so it can be ignored. But overall differential revenue and the differential cost are always relevant. But the indifferential or like in incremental, like identical cost are irrelevant in the decision making. And then the other two cost concepts, opportunity cost and sunk cost. You may heard about these two items in other classes or in maybe reading like newspapers or articles, because those are very popular items in brand management issues. Opportunity cost is used not only for professional or business management, it can be applied to your personal, your family, or personal finance or other decisions. So opportunity means when you have two opportunities, right? You have some resources and you have the resources to pick opportunity over the other one, or like one option or over the other one. You cannot choose both. Be careful. Or normally you cannot choose both. You only can pick one from the scenarios. So when you pick one over the other, you will lose the benefits for like the choices you didn't choose, right? Like, so in that case, we'll pick one option over the other one. You sacrifice the benefits for the options you give up. Then that benefits becomes the opportunity cost of the option you chose. It's not really something you pay or you incurred, but is a lost benefit, right? So lost benefits. Very simple, like if you choose to work, like for example, if you want to be a full-time student, for example, so I want to be a full-time student. So in that case, I may sacrifice the working opportunities, like more hours of the working opportunities, right? Like the wage, salary, benefits you give up by taking more hours of work will be the opportunity cost of being a full-time student. But you may say how I can evaluate, right? So how much value I can give to being a full-time student is not really financial, right? So it can be a higher GPA because you have more time to study, and I can graduate more early, right? So more quickly, so a shortened study time. But anyway, I'm just using a common example, right? So we can make comparisons. Or in other situations, if you choose one job over the other one, you cannot work for both. So I choose to work for a company over the other, then you compare, right, maybe the benefits or commute cost and some. So, but anyway, the net benefits you give up for the job you didn't choose becomes the opportunity cost of the job you finally pick up, right? So that is always like a relative for the opportunity cost. So opportunity cost is always relevant, right? So when you pick up one option than the other one, the opportunity cost you give up is always relevant. So if you forgot the opportunity cost, you may make a wrong decision or calculate the wrong the value, right? Or like the net benefits for the options you chose. Then sunk cost. With this one, lots of people they didn't realize the sunk cost is always irrelevant. Or on the opposite, sunk cost is always irrelevant, even they already incurred. So it means you already paid the cost sometime before. But lots of people will fix down the payments. Okay, thinking I already paid my car or paid the machinery, then I have to use it forever because I want to recover the cost I paid. But this vision may give you a wrong decision-making case because like the example the book is discussing here. So the company paid $50,000 a few years ago for a special purpose machine. And the machinery was used to make a special product. But this product quickly become obsolete and lose the market. So if you are the manager, so what's your option? So you continue to use the machine to make products. Is very hard to sell, right? Or you think about can dispose the machine to sell it, like maybe by lower, to sell it below the book value, right? So if you sell it, you may have a loss. Or if you continue make products, the product is hard to sell. So in this case, you shouldn't focus on the $50,000 I already paid. It's already sunk cost. So right now you should ignore the 50,000. So rather compare maybe like maybe modify the machine for other products. So make some alternation for the product or for the machine so you can use it for other purpose. But in this case, you need to incur more cost to do the modifications. Or just sell the machine as it is, right? So with some cash, you may have a financial loss, but the 50,000, what we focus on here is irrelevant. So when I choose the modification of the machinery or sell it as it is, the 50,000 is irrelevant. So you shouldn't just focus on, oh, I need to continue to use it until I cover the cost. That's the wrong decision because the more product you make, is becoming inventory and you couldn't sell, then eventually it's still loss for the company. Okay, so that's applied to your personal. So lots of the times we have used a car. So we'll think about trading the car or continue to drive it, or you have a big requirement, right? So we'll compare the different ways for the car. The cost you paid for the car is irrelevant, is sunk cost. You shouldn't think about, oh, I paid about this 30,000, very expensive 5 years ago, but is irrelevant, okay, for our current decisions. So sunk cost, when you use a simple case, is easy to understand, but when managers sometimes face a complex situation, they may bring it into the consideration, which should not happen. So, but the sunk cost is also a common item the managers faced in their decisions. And there are also some other ways the managers can classify the cost. We are not really exhaustive on the application in the real business world. For example, sometimes we look for the cost is controllable or uncontrollable by the division or department manager, right? The controllable or controllable is really depending on which job position you are looking for. The controllable cost means I can change my plan, like my department budgets. So for example, I want to reduce the advertisement because of the short of funding, right? Or I want to reduce the research and the development. So it's controllable. But sometimes uncontrollable means like the sunk cost. Or like some cost we committed as long-term investments, right? So the building, we already started the construction, or the employee we hired like on long-term contracts. So the controllable or controllable give you an idea for the responsibilities, right? So do you have flexibility in controlling the cost? Or value-added cost or non-value-added cost. If you produce waste items, right, like, the defect items, we waste the resources, materials, labor, because the product has defect. You cannot sell it. You have to lower the sales price. So as in management, we have lots of cost concepts they used in the real business. So we are trying to introduce most of them, and you will see more applications later. So this topic is very important. Let's try a multiple choice before we wrap up. So which of the following statement is true? You may have more than one answer right. So analyze one, like each of them. Okay, first, a common cost is one type of direct cost. I like this question. It's very nice because it really helps you critically think the cost concepts we have learned and apply it, okay, to decide. So a common cost is a type of direct cost. So first you need to understand what a common cost means it happened for multiple cost objects. Common, right? So if it happened for multiple cost objects, then it should not be a direct cost. Direct means it's related to a cost objects directly. So a common cost is normally indirect costs, like the common utilities, the utility expense for all of the office building, right? Then for each department, the utility cost is common cost. The number B, a sunk cost is usually a differential. We just talked about sunk cost is irrelevant, is non-differential between the options. Either you modify the machine or you sell it as it is no difference on the 50,000 sunk cost. So sunk cost is always indifferential. Okay, so A and B are all wrong. Then C, opportunity costs are not usually recorded in the accounts of an organization. That's right. Opportunity cost is not something you really paid, okay, and recorded. It's only the benefits we give up, okay, by choosing one option over the other one. So it's a concept cost when you compare two different situations. So C is right. And a particular cost may be direct or indirect depending on the cost object is absolutely true. As we went over the other practice, right? So when you decide is it direct or indirect, you must identify the cost object. A indirect cost for one cost object can be a indirect cost for another cost object, or it is case by case. And finally, they have a real business case. Okay, talking about kind of the new service. So new type of healthcare service, mental health service by CVS or Walgreens, or like they pick up after the COVID-19. And why they pick up this line of business? Because of the high market, like customer demand. They are looking for more revenues, okay, earning more revenues than incurring more cost. So overall, they are looking for the incremental revenue exceeds the incremental cost, or differential revenue over the differential cost, okay, by providing these mental health services. So as a result, they can increase the overall benefits, like overall profits of the company.